Bienvenidos a todos. Welcome to Sectors Made Simple. Today, I'm going to answer a very common and very important question. How can we find leading market sectors? This is something that can benefit investors of all skill levels with many different goals. It doesn't matter if you're looking to day trade, swing trade, or find an opportunity for a long-term investment. For everybody, understanding what sectors are and the different ways that we can find the top sectors is an invaluable resource to have. So I want to explore this topic with you all, take a look at some different ways that we can find sector leaders using Sectors Made Simple, and cover some strategies that will let us take advantage of what we've learned. So let's dive right in, starting off with the boring part, the disclaimer. Today, I'm going to talk quite a bit about some examples of strategies and also my opinions. Those are my personal opinions, and the strategies are meant for educational purposes. They are not a recommendation to buy one company or buy another company. In fact, that's exactly against the point of why we're here. The goal is to help teach how we can think about investing and use the information available to us to make informed investment decisions. So that's the goal. Nothing is a recommendation, everything is education, and past results cannot guarantee future performance, which is why it's important we do our own research. So today's topic is a very basic one in theory, and in practice it's pretty easy as well. Let's find the top market sector. So we're going to start off by talking about why we should care in the first place. Why do we want to, or sometimes need to know what the leading sector is? Then we'll go into why it matters that we have more than one way to find the leading sector. I will share with you 4 different ways to find the top sector. And if your eyes are starting to already roll to the back of your head, don't worry. I will explain to you all how simple all 4 of these ways are, but also I will tell you the benefits of each one and which tools or strategies can benefit the most from them. So you don't have to go into this thinking you need to learn 4 brand new things. The goal should be that you can take one thing away from today and run with it. But when you're ready for step 2, you can come back and check out what the other methods are. So we'll cover which tools can benefit the most from the way of finding the top sector, and an example of a strategy that uses that information. So let's start off very, very basic. What makes the top sector the top? Very simple question, but there are a few answers. First, it could be the sector ETF that's performing the best. If I want to know what the top sector is, what better information is there than the sector that's leading the market right now? Pretty straightforward. But another way to answer it is which sector is gaining the most strength. It's great to know who the leader is today, but that doesn't mean that they're going to continue to be the leader. Sector rotation is a big idea and a big concept of investing. Certain sectors will do better or worse during certain parts of the year, parts of the economy, bull markets, bear markets, and understanding which sectors are moving up and down can also be a part of deciding what the top sector is. But another answer could be, it's home to the strongest companies. I don't think it is a far reach to say that some of the most important companies in the market right now are companies like Nvidia, Google, Microsoft, Tesla. All of those companies are parts of the technology, the communications, and the discretionary sector. But does that really mean that those sectors are the strongest? Or are those companies just diamonds in the rough? And then the last one, it's got the most room or opportunity for growth. It's fantastic that we can find sectors that are generating and creating profits today. But the market doesn't always go up. What goes up will probably come down just a little bit. What do we do when we're in a bear market? What do we do when we are looking at a stock market saying there aren't any opportunities right now? Where should I look to find the early signs of recovery or the first opportunities that are emerging? So there are 4 different answers, and each one is correct. None of these answers are wrong, but they're all unique as well. Each one of these answers is a perfect answer for one goal or more than one goal. And I want to share with you all why and give some more specific examples. But before we do, why should we even care? Why should we worry about sectors and bother even learning new information? Well, investing is all about opportunity. It is the opportunity for growth. It is the opportunity for recovery. It is the opportunity for consistent returns. These opportunities will be completely different depending on what our goals with investing are. Not everyone is an active day trader that is looking at their stocks and investments all day, every day. Many people just want to put their money in something that they want to grow over time and are more about something like the buy and hold strategy. Meaning, you find a company that you want to buy, you buy it, and then you hold it. You don't sell it for a while, and eventually you sell it. A lot of people don't really give the buy and hold the credit it deserves because it means that we don't need to put in as much constant work. Yes, we want to keep an eye on our investments, but it doesn't mean we're going into our investment account every single day and waiting for something to happen. It doesn't mean that we have to be thinking about, is the stock going up or down? Do I need to sell right now? See it, set it, forget it. But they want to make more confident decisions. When they buy something, they want to know that they made the right choice. When you buy a car, you don't just buy a car based on what you think looks prettiest. Okay, maybe we like the car that looks the prettiest, but you're also going to think about what's the fuel efficiency? How many seats does it have? How much stuff can you put in the trunk? Does it have a trunk? All of those things will go into, do you want to buy the car or not? Unfortunately, we can't really test drive stocks very easily, but the rest of the metaphor kind of applies. The more information we use to choose the right company, the more informed of a decision we can make. But then there's the active traders, the people that are looking for those opportunities, either on the order of a few days or a few weeks. But here, you're not looking at the buy and hold. You're not looking at the dividend companies. You're looking at whose prices are moving right now. Where can I make a quick buck off of flipping a company or trying to ride a wave of momentum in the market? So, learning which sectors have those opportunities is a huge benefit because it can benefit everybody from passive investors that don't want to learn a completely new skill, but still want to know that they're putting their money in the right place, all the way up to the active traders whose most valuable resource is their time that they're spending finding these opportunities. So, why do sectors actually matter? Well, they can narrow down our search. There are over 5,000 companies that we can invest in the stock market, and that's a lot of options. So, sectors can be a great way to narrow our search. Why? Because according to an IBD study, around 50% of a stock's price is due to its sector and its industry. Meaning, if we can track and find the top sector, that's half the battle. We have already narrowed down our search so much by finding the leading sector. It's like playing a game of Guess Who, but instead of having to say, does your person have glasses, and only getting to put down a few of the cards, you get to say, well, is this person something? There's not really anything that is get rid of 50% of the board. If it was, the game wouldn't be very fun. So here, we can narrow down, we can get rid of 50% of our options by choosing a sector. So if it comes down to something like finding the top performing company out of the S&P 500, 500 companies, or the entire New York Stock Exchange, 5,000 companies, sectors can benefit us in either case. It is a way of reducing how many companies we need to look at while improving the quality of the companies that we're looking at. So if we can find the top sector and filter to only show companies within that sector, our jobs become a lot easier. I want to do an example with you all. I'm going to go to the website FinViz, which is a stock screener that I like to use quite a bit whenever we're not talking about SMS tools, because it covers a lot of both technical, price-related stuff, but also fundamental details about the company itself. We just published a video today, actually, on how to use FinViz to filter companies based on qualities that would make up a strong company. I'm going to just save us a little bit of the kind of thought process behind it. If you want to see the whole process, go check out that video. But for here, we're just going to go through the quick stuff. We're looking for EPS growth quarter over quarter above 15%, a price to earnings ratio under 25%. I'm going to leave that blank for right now. We want to find a return on equity above 15% and a beta of under 2. Lastly, I want to find companies that are 0 to 10% below their high price. If you're familiar with Be a Profit, this is a lot, or these are all features that make up Be a Profit. Okay, 193 companies. I'm not going through 193 companies. So this is where something like sector can come in. If we now say, I think the technology sector is the top sector. Now we're down to 34. Maybe I think cyclical, which is the discretionary sector, the I wants in life, our vacations, our cars, our fancy clothes, our Amazons and whatever in the world Amazon is these days, those are cyclical. So if we look at cyclical, we're at 24 companies. And we can narrow it even more. We could just look at the S&P 500. Oh, hey, 5 companies. I can deal with that versus the 54 that we would have had if we didn't choose a sector. This is a perfect example of why filtering by a sector can matter. Often, it will mean the difference between 50, 15, or 5, depending on how many options or choices we want to have. So that's great. We understand what a sector is, the impact that the sector itself has on the price of a company, and an example of how just filtering by sector can narrow our search by a huge margin. But how can we use that information? Once we've found the top sector, now what? Well, I just gave you one example, but studying the sector itself can give us a lot of different benefits. We just walked through one, which is using the sector to filter down a list on a stock screener like stock charts, or some of the screeners we offer with Sectors Made Simple. The other one is that we can invest directly in the sector itself through its ETF, or exchange traded fund. You like technology companies? I like technology companies. We can buy technology. Literally, there is the sector ETF for technology, XLK. This is the sector ETF for technology for the S&P 500. If we go over to a website like ETFDB, we can see what that sector ETF is holding. What is it holding? Well, it's a lot of NVIDIA, a lot of Microsoft, a lot of Apple, basically everything that goes into technology is in this sector. And you'll notice the percent of assets, how big is that slice of pie? Because not all the slices are equal size. NVIDIA, they get the biggest slice at 15%. Intuit, anyone want to talk taxes? Sorry, sore subject. 1.74%. Almost 10 times less than NVIDIA. So with this, you are buying not one company, you are buying the performance of technology. You are buying that 50% of the stock's movement is due to its sector. So that information is extremely actionable when you find a good sector and you have the ability to invest directly in that sector. And then the last one is a little bit more of the exploration side of things, which is finding potential opportunities. It's not saying what I can buy today. It's saying what could I buy tomorrow. But the big question remains, because now I've showed you why finding the sector is valuable and how we can use the information of this is the top sector. But how do we actually pick it? I promise you it's not eeny, meeny, miny, mo. It's a lot easier than that. Because we actually have a few choices. There are multiple ways. Rather, there's infinite ways to pick a top sector, but we're just going to narrow it down. I'm going to share with you a few ways. Because Sectors Made Simple has quite a few ways to find the top sector. Go figure. Sectors are a big topic for Sectors Made Simple. The name is kind of a good representation of what we're all about. To kind of defend that, we've created a number of different tools that let us find the top sector in a couple of different ways. Each one of these ways has its own benefits. Each one is unique and will work the best with certain types of tools or certain types of strategies that we offer and teach. So I want to talk with you all about the 4 different ways that we can find the top sector and examples of how we can use that information in a trading strategy. Starting off, we're going to start off with the easiest, the one that I think most people will be able to use for their investing, and we'll get a little bit more detailed and a little bit more nuanced as we go along. First one, highest relative strength. Relative strength plays a big part in many of the tools that we've created. And the flagship of our tools is the sector summary. It shows us the strength of each sector's ETF, so each sector, and its score compared to the rest of the market. I'm going to quickly show you what that looks like so we're all on the same page. Here we have our dashboard of tools, and we have the sector summary page. Además, si prefieres obtener esta información en español, puedes elegir aquí Mostrar español adentro de Ajustes o Configuration, or Settings. Voy a cambiar la idioma y podemos continuar. Alrighty, showing where we can change the language of the tools to Spanish. Sorry, actually, I want to do one more thing. I want to split up our matrix and momentum because we'll come back to momentum in a few minutes. I just want to start off with the matrix. Each sector has a score, has two scores actually. Its long-term strength, its short-term strength, and the combination of the two, total count. Is short-term better to use than long-term? Is long-term better to use than total? My simple answer, 99% of the time, just use total, unless there's something you're trying to do, like short-term trades. If you're trying to day trade or swing trade, short-term might give you better results, but I don't really want to commit to that because I haven't done a back test. Kind of hard to do a back test to show that. But in reality, 99.9% of the time, total count, we can just focus on that. What we see here, though, is the score for each sector. For example, XLC, which is communications, has a score of 20. XLE, which is energy, has a score of 8. 20 is bigger than 8. Communications is stronger than energy. That's all there is to it. We can sort this table to see the highest strengths and the lowest strengths. To me, this is the simplest answer to the question, which sector is the leader right now? The matrix, all of that information we just looked at, updates every single day. And it is a picture of who the leaders are today. Not the 1 week returns, not the 1 month returns, the current leaders today, September 23rd, 2025. It is important to note, by the way, these sector ETFs are market cap weighted, like we saw when we looked at ETFDB. The bigger companies have more of an impact on the sector. So when we're buying one of these ETFs, we're buying the performance of that sector, and more of that performance will be due to the bigger companies than the smaller ones. In my opinion, the biggest benefit of using this method, looking at relative strength to pick the top sector, is that they are based in a point in time. They are telling you who the leaders are right now. And they directly compare all sectors against each other. The beautiful thing about cap-weighted ETFs is the fact that these are things we can buy. We say technology is the strongest sector. Well, that means that XLK, the technology ETF that we can go to our broker and buy, is the current strongest sector. Also, it lets us compare all of these sectors against each other. So we can compare technology to communications. And that comparison means something. It goes up and it goes down over time. So here's how we can use highest relative strength. The best tool, in my opinion, to use this information with is the sector summary itself. We don't need to look very far. Sector rotation, the idea that certain sectors will do better or worse than others, is a very strong force in the stock market. It is not something we invented. It is something that has been studied and proven for decades. All we're trying to do is make that information easier to understand and more accessible. But sector rotation helps us to understand who the current leaders are. And being able to see who those leaders are help us to understand what kind of market are we in. Is one sector just getting really lucky? Or is sector rotation playing an important role? So I want to quickly look at the dashboard again with you all, and we're going to jump forward a few chapters in the sector rotation lesson book here, but bear with me. When the stock market, when the economy is growing, from the stock market perspective, we would expect sensitive sectors to perform the best. That probably means nothing to you, but here's what that actually means. Sectors like technology, communications, and discretionary are three of the sectors that we would expect to do the best when the economy is growing. Why? Because typically, they're the companies that have the most growth. These are growth companies. Is Nvidia turning $4 trillion in sales? No. Do they have $4 trillion in an account somewhere? Definitely not. And if they do, toss me some. Nvidia is valued at $4 trillion because of what they could be worth, what they could grow to be in the future. Just like Amazon, just like Tesla, just like, well, kind of Intel. Well, let's talk Intel. What happens when a growth company doesn't grow as much as we would expect? Well, let me show you. If we look at something like Intel, actually, I want to look at this chart instead. Cool, up 2% today. Great. Up 19.5% in the past month. Awesome. Up 30% in the past year. The last 5 years, but hey, look at the last year. This is a great example because Intel is a growth valued company. We are thinking about what Intel could be worth in the future. And when it's good, it's really good. This was a deal that they made with Nvidia. They cut a deal with Nvidia where Nvidia is partnering with them and investing money directly into Intel. That gave them a big bump, not because they got paid a ton of money right away, but because of what that deal could do in the future. Just like we saw their stock price tumble 62% when that growth valuation that they had went from a beautiful carriage back into a pumpkin at midnight. That is the general theme of these sensitive sectors. They can offer huge returns, but their value is not what they're worth today. It's the feeling that they'll be worth more in the future. And the minute that feeling is broken, like, a bear market or a recession, those companies will see the largest losses. They're more sensitive. On the other side of things, though, we have defensive sectors. These are things like utilities, because everyone needs their gas and water regardless of how the economy is doing. Energy, same kind of deal. Healthcare, everyone needs to still go to the doctor. And staples. Staples are the I needs in life, like our toilet papers and our Costco hot dogs. So if what we think about sector rotation is true, we would see sensitive sectors at the top, defensive sectors at the bottom. And hey, that's exactly what we're seeing right now. So the sector summary page doesn't just show us who the leader currently is. It gives us a better idea of the strength that each sector has. So we can see, is sector rotation what's driving the market right now? And here, it kind of looks like it is. We see our defensive sectors being some of the lowest strength, while our sensitive sectors are the strongest. That information can be very, very helpful for us if we wanted to directly invest in any of these sectors, or use this information to try and figure out where and when we think a bear market might begin. The other side of it, though, is a lot more straightforward. We've created a lot of trading strategies. These trading strategies invest once per week by buying one thing per week. And, well, I'll have the results speak for themselves. If we go to strategies, I'm going to sort by the top 6-month returns. What we find is that our Wednesday strategy that is currently buying technology has a return over the past 6 months of 21%. versus the market's 15, with a risk of 4% versus the market's 7. We have created a number of strategies that have offered higher returns and lower risk than the market in the past. And while past results can't guarantee future performance, these strategies have held up throughout time. Also, the information that these strategies use is the sector summary. That's all it's using. No crazy magic, no private resources that we don't give you access to. If you're determined, you can read through how every strategy works, test out the strategy yourself, and see what information it's using. And the information is the sector summary. So ultimately, picking the top sector is something that can directly benefit us by being able to see which sector is the best right now, market cap wise, if we were interested in buying just that sector. It can help us figure out where in the economic cycle are we, but I don't expect everyone to do that on a daily basis. Or we can just choose to say, I think that's cool. Give me the strategy. And the sector strategies, the matrix strategies, handle all of the heavy lifting for us. That brings us now to method number 2. We're staying with the sector summary page here, but now we're looking at momentum. Instead of looking at relative strength scores, who the leaders are today, we are looking at how these scores are changing over time. I mentioned before that every one of these relative strengths, 21, 20, 18, these are the strengths today, which means the strengths tomorrow might be different. And we help you track that. Our momentum table here lets us see how the relative strengths have changed from some point in the past to today. So we can see compared to yesterday, Monday, September 22nd, SPY gained 1 long-term strength and lost 2 short-term. Communications gained 1 long-term, 1 short-term. Industrials, XLI, lost 1 long-term, 2 short-term, so on. So this can help us to understand who may become the leaders in the near future. And the benefit is that we can see changes in leadership over any time period. I showed you 1 day here, but we can also see 1 week, and we can also order it from highest to lowest. 2 weeks, 1 month, 3 months, or if you don't like our choices, pick any date in probably about the past, I believe, 7 or 8 years. So momentum is highly customizable and very, very valuable to show us how these strengths are changing and which of these sectors is gaining or losing strength over time. The ways that we can use momentum are, again, very straightforward. The first being matrix strategies. Half of the matrix strategy uses the current top sector. The other half uses what sectors are gaining or losing strength over time. Well, actually only gaining strength over time. But in my opinion, momentum is a great option for any short-term trading strategies. This is really the best information that we have to show us which sectors are moving in relation to the others in the market. And that information updates every day, meaning that we can go in, see which sectors are gaining strength, and then look at those sectors and focus on those sectors for options or swing trading strategies. The reason? Daily updates means that we constantly get to see how the market is moving day to day. And we can adjust our momentum to see more or less information. Let's do an example. We've looked at, we're going to do an example and not jump to method number 3 just yet. I want to find the top sector because I want to look at swing trading opportunities. How would I do that? Well, let's sort by total count. The highest score that we can have is 22. The lowest is 0. Thank you, Staples, for being our example of the lowest score. Poor Staples. In my opinion, 2 is some change, but not really enough for me to say this sector is making moves right now. So let's look 1 week ago. All right, now we have communications, technology, and utilities, SLU. But still, they're only 2. Give me something a bit with a little bit more oomph behind it. If we look 2 weeks ago, all right, 5. That's a big enough change. If you don't want to start dissecting all the numbers, darker green box means a bigger change. That's all there needs to be to it. So now I know that technology is the sector that is gaining strength over the past 2 weeks. We can then go to a tool like, well, if we're interested in swing trading, how about the swing trade setups? Here we have a list of 1,900 companies, and we can filter by sector. So let's filter to only show technology companies. We're down to 98. Okay. Let's filter to only show companies on potential breakouts. And by the way, if you're interested in learning more about this strategy, I have covered this in a past webinar this September. But what we're looking for here are companies that are testing levels of resistance, meaning they are trying to create a new high, but first they've got to fight the final boss that was the last high price that they had before the price went down. So potential breakouts means that we're finding opportunities for companies that might break resistance and continue an uptrend. Here, now we're down to 12 companies. Well, we can keep adding more. We can say, I only want to see companies that are already on breakouts. Okay, now we're down to 8. 1,900 to 8. If we didn't have the sector, we're still working with 152. I don't have the time nor patience to go through 152 companies. I want to save myself time. We can use momentum to find the sector, filter by the sector, and have way less choices to have to consider. But same, if not higher, quality of companies. Why? Because now we've found companies in the top sector, companies that are testing levels of resistance, which would be our swing trading strategy. And we're not trying to reverse a signal. We're not trying to change the current of a river. We're just trying to go with the flow. Again, we have covered this strategy in other webinars, so I don't want to go too into detail with this. But this is, again, a great example of where choosing a sector, a top sector, can significantly decrease how many options we need to look at. Now we get on to my personal favorite, sector strength averages. So far, we've looked at relative strength of market cap weighted sectors. XLK is market cap weighted. NVIDIA matters more than Intel. But here, we're not looking at the market cap weighted sector. Instead, we are looking at every company within the S&P 500. All 500 companies. Which is why the sector strength averages are located on the S&P 500 screener tool. It uses the information from the screener to create these averages. And the key difference is that we can see how many companies within the S&P 500 a given stock is outperforming. Let's go and look at that together before we get any further. To create this information, by the way, every day we compare all 500 companies against each other, in 249,500 stock charts, but who's counting? Here, we boil it down to simple percentages. Think of this like the report card, but we don't have to worry about our own grades. Instead, we get to look at the grades of everyone else. Higher percent means higher strength. So we can read this like saying Apple, AAPL, is outperforming 91.5% of S&P 500 companies. A, which is Allegiant Healthcare, I believe, is outperforming 60%, while Airbnb is outperforming only 44%, ACGL 26.9%. You get the idea. So with one simple number, we can compare all 500 companies using 250,000 stock charts and find the leaders. That's really cool. We've developed a lot of strategies using that. But what we're interested in isn't the relative strength of every one of these companies. Instead, I want to find which sector has, on average, the strongest companies. What we can do is take the relative strength of all of the technology companies. So if I were to filter here by technology, we take 91.5, 25.5, 65.9, 62.8. We find the average of all of these different companies within the technology sector, and then we call that the average strength of a technology company. The value here is that if we're interested in investing directly in the S&P 500 and a company within the S&P 500, sector strength averages is by far the most accurate way we can do that. Why? Well, it doesn't matter. What is a bigger price gain? 5% return in NVIDIA, 5% return in Broadcom, or 5% return in Micron? They're all 5%. It doesn't matter if it's the biggest company in the S&P 500 or the smallest company. So why should we give more value to NVIDIA than Micron? They both can return 5%. So using sector strength averages, if we're interested in the companies themselves, is the most accurate filter we have. And it might even show us sectors that we might not have looked at otherwise. Let's go back here and I want to show you an example. If we scroll down below the screener and its momentum, we get the averages for each sector. We can sort this by total, and here we see some obvious features. Technology, strongest with an average relative strength score of 59.8%. Communications, no surprise there, 52.9%. For those keeping track at home, if we look back at the matrix, we had a loading screen. Let me refresh. Sometimes when I'm going through too many examples, you got to hit the quick refresh button. We had technology, checks out. Communications, checks out. Discretionary. And then financials, pretty far down the line. Well, we go back to the S&P 500 screener. We go down to sector strength averages. Here's technology. Here's communications. Here's discretionary. It is the third weakest sector overall. If we looked only at short-term strength, it is the second weakest sector overall. What does that mean? Well, that means that discretionary is really only doing as well as it seems because of a couple of really big companies. Companies like Amazon or Tesla. If those companies are performing well, we could see XLY, the discretionary sector ETF, performing way better than the average company within discretionary, which is why we see discretionary down towards the bottom. And then financials. Financials is basically tied with communication services for average relative strength. So what that means is that there are a lot of companies in financials that have the opportunity to shine if we invested in that one company. But if all we looked at was relative strength of their ETFs, or just the ETFs in general, we might miss them. But I'm not interested in third place. Like the great Ricky Bobby once said, if you ain't first, you're last. So I'm really only going to focus here on technology. Thank you, by the way, if you get that quote. If you don't, thanks for entertaining my ridiculousness. We now know that technology has the highest average strength. So we go here, filter by technology. So now we're only looking at 76 companies. So what we're doing is using the sector as a filter within the S&P screener itself. And from there, we can do any trading strategies that we want. One of my favorites is finding recent breakouts. We talked a little bit before about using swing trade setups to find companies that might break out in the near future. But I'm impatient. I don't want to wait for what could be in the future. I don't have that time. I don't want to put that time in. I have time right now. I want to make a decision right now. So I care more about what companies just went on breakout. Well, you can see that. If we go here, we can filter to only show breakouts. Go figure, if a company is entering a breakout or recently went on one, it'll be on a breakout. I want its price to be going up. And over on the right side, by the way, if you're doing this on your own screen, it will look a little bit more like this. I'm just making it huge for the purpose of the webinar. So over on the right side of the screen, you'll find signal date. This is when that breakout happened. And I can sort to show the oldest breakouts and the most recent breakouts. So this information updates once per day. This information here is for yesterday, September 22nd. And yesterday we had Uber, TER, Oracle, NVIDIA, and MPWR all go on breakouts. That is 1, 2, 3, 4, 5 companies that went on breakouts yesterday. 2 went on breakouts on Friday. And now you might be asking me, okay, great. I've narrowed it down to the 5 companies that went on breakouts today. Do we do eeny, meeny, miny, mo again? No. Here's where we can use something like custom matrices that lets us take a list of companies, plug them in, and find which ones are the leaders out of just that small group. We're already on the topic, we might as well do that. I'm going to take a quick picture of the 5 companies that just went on breakouts. We're going to make a custom matrix for it. Tech companies on breakout 922. And here we'll plug in MPWR, NVDA, ORCL, TER, TER, and UBER. Almost said UBER. Alrighty. We'll give that a few minutes to load. But going back to this screener for a quick second, this information is something that we can do at any point. You can do this over the weekend. You can do this in the evening when you've got some time, in the morning while you're having your coffee. And you don't need to go to 15 different sites. You don't need to go and look at a single stock screener. You don't need to, you look at a stock screener. You don't need to look at a single graph or chart for a stock. Sector strength averages, Give me the strongest sector. Filter by that sector. Find things with recent breakouts whose prices are going up. And we're done. If you want some help figuring out which of these companies is the best of the best, you can create a custom matrix to see exactly that. Keep in mind, if you are creating a custom matrix that hasn't been created before, we are making this information just for you. So it does take us a few minutes to load up that info. So I want to get started here with method number 4, and then we'll revisit our friend in a few seconds. The last method I want to talk about is Bullish percent index, or BPI. This is great if we want to expand our search outside of the 500 S&P 500 companies. To find bullish percent indices, we can use the Sector Explorer tool. If you're not familiar with what BPI is, here's a quick explanation. It's a risk indicator that helps us to figure out how much risk or how little risk there could potentially be in a group of companies, notably sector. The higher the BPI, the higher of a chance there is that that group of companies has been overbought. There's too much heat in that group. But the opposite is also true. The lower the BPI, the smaller the BPI, the more chance there is that it has been oversold, meaning there's more room for opportunity. BPI is a percent between 0 and 100 that tells us what percent of companies within a sector are currently on a buy signal or a breakout. With Sectors Made Simple, we offer sector BPIs that no one else does, which means that we have sector BPIs for the NASDAQ exchange, the New York Stock Exchange, and the entire stock market as well. With this, you can not only see what the BPI is right now, but you can see if the BPI is going up or down over time. Before we dive into our strategy, let's wrap up the method number 3 and take a look at who the best of those 5 companies actually is. Well, we actually still have a tie. We have Oracle and TER both tied with a total count of 5. We can check momentum to see if one of these is gaining strength faster than the other. They're both gaining strength. In this case, both would be reasonable options as far as the data is concerned. But now we're going to move on over to the Sector Explorer and take a look at the BPIs together. Using BPI is, in my opinion, the most advanced way of finding the top sector, but there are 2 common ways that it can be used. The first is we can use it as a confirmation. We can find a company we're interested in buying. We're going to take the example of Oracle, ORCL, that we had just found. We can plug that into the Sector Explorer and see which BPIs include that stock. That will give us an idea of the potential risk that that company has due to its sector. If 50% of a company's price is due to its sector, it means that 50% of the risk is due to the sector as well. So if we understand how much risk that sector or that group might have, it can give us more or less confidence in that decision. So let's try that together. We're going to go here and search for Oracle. And if we scroll down, we'll see some basic information. It's a technology company in the New York Stock Exchange. It is a mega cap company, and it is a stock, not an ETF. Here we can see which BPIs it's a part of. It's part of the New York Stock Exchange Tech, the mega cap tech for the New York Stock Exchange, and total market tech and mega cap. I'm going to focus here on all tech. We click that. What we can see is the BPI chart, if that's something you're interested in. But more importantly, we can see that right now the BPI is 48%, and that BPI is going up. 617 companies within this group are on buy signals, breakouts. 495 are on sell signals, breakdowns. But here's the important thing. Current BPI, 48%. We consider overbought to be anything close to or above 70. So we're good there. Current column X means that the BPI number is going up over time. Looking at the chart can confirm that. So, in my opinion, there is still room for tech to grow. Is it the most valuable sector right now? Yes. Has it been the most valuable sector for a few weeks? Yes. Does it still have more room to grow? Also, yes. So this is a great example of where we can get a positive confirmation for a sector. But all sectors will have different BPIs. And another way we can use it is to find areas of opportunity. Not opportunity right now, but opportunity in the future. What are the other numbers in green and red? So the green tells us how many of those companies are on breakouts. The red tells us how many are on breakdowns. This lets us see every single company within that group and their individual signals. So we can see Apple is on a breakout or buy signal in a column of X's, price going up. So I could filter it. Anna, you're jumping ahead. Because you are talking about exactly what strategy number 2 is. Areas of opportunity. When BPIs, just like as a BPI gets closer to 70% or goes above 70%, there's more risk if and when that BPI starts to go down. An area of opportunity can be created when a BPI is going down at to or below 30%. This is a sign that group might be oversold, and there's a lot more room for opportunity if and when that BPI reverses back up. So we can monitor sectors with low or descending BPIs, and when that reversal happens, find companies that might be ready to go on buy signals next. There you go. So let's go quickly to the Sector Explorer, and I want to look at all of the market BPIs. And we're looking for a BPI that is low, as close to 30 as possible, in a column of O's, meaning it's going down still. Oh, hey, Staples, 35.8%, currently going down. If we click into this, we are now waiting. We are waiting for this column to reverse, meaning companies are starting to go on buy signals faster than sell signals. And how do we know where those opportunities might be? Well, we can see the performance, or rather the signals, for each company in that group. So I can look for companies whose prices are green, positive, but are currently on sell signals. If we were looking for what companies might go on buy signals next, this would be a great list to start with. For each one of these companies, we can click on it and see its point and figure chart directly on the screen, or directly on the Sector Explorer itself. So it's quick and easy to go through these different choices and see which charts make the most sense for us. But this opens up a world of charting analysis, and that's a story for another day. But hopefully, this would be a great indicator of if the market's going down, if we are in a bear market and we're looking for the first signs of recovery, BPI is a great place to be looking for those early signs of recovery. And the Sector Explorer is a super simple way to find companies that are approaching but have not broken out just yet. So this would indicate that it's a good time to buy the ETF itself. So that's a little tricky. I'm going to just say the answer is no, unfortunately, because these BPIs are more than just the S&P 500. This is the entire US stock market. So really, we're looking at a bigger universe than just the S&P 500. So that's why, in my opinion, using BPI for something like a confirmation might be better than using it for using the top sector on the matrix. As often as we can, comparing apples to apples is the best, but sometimes there is no apple to compare it to. So we find something that is very similar and can offer us more information than just playing guess and check. Which actually leads us well into the last question I want to answer. Are there wrong ways to use the top sector? In my opinion, no. And these are my opinions of why. Choosing one way to find the top sector versus choosing another won't mean that the strategy will work or not work. It's not going to be this huge thing that is going to completely ruin your strategy. Because at the end of the day, if 50% of a stock's movement is due to its sector, that means that using sector information at all is going to be more meaningful. And any method to find a top sector, in my opinion, will improve a trading strategy over not using sector information at all. But certain ways of deciding who the top sector is may reveal opportunities that others might not. Using BPI can help us to find early signs of recovery if we're in a bear market or the market is currently declining and we're waiting for early opportunities. I'm probably not going to use BPI as part of a matrix strategy. But again, if our goal is to say, what is the top sector? If you noticed, technology popped up over and over and over. There's a good reason, because technology is the leader. And if anything, using multiple different ways of figuring out the answer and answering it by asking the question slightly differently every time, which one has the most momentum? Which one has the best average strength? Which one has the best ETF? If the answer is technology over and over and over, it gives us a lot more confidence in that answer, meaning we can make more informed decisions. So if I had to make my decision of which method should I use or would I use, I would use the one that makes the most sense. The goal today was not to overcomplicate things or tell you you need to use all four. The goal was to share with you how many different ways there are to come to that answer, explain where one might be slightly better than the other, but to prove the value of why studying sectors in the first place is so important and why using it to help narrow our search or to make more informed decisions can benefit us as investors for everything from day trading to swing trading to buy and hold. So let's quickly recap our 4 ways to find the top sector. There are 2 ways to do it with the sector summary. First, we can find the top sector by total count, which would give us our current leader. We can find the top sector by looking at momentum, which would show us which sector is gaining strength the fastest. Sector strength averages on the S&P 500 screener can tell us on average which sector has the strongest companies, while finally sector BPIs can show us which sectors might be overbought, meaning higher risk, or oversold, meaning more opportunity. Unfortunately, that is all the time that we have for today. I want to thank you all so much for making it this far into the webinar. It is such a pleasure and an honor to be able to share these tools with you all, to demonstrate how these tools can benefit traders of all skill levels and all goals, and prove why sectors can be made simpler with the right set of tools, knowledge, and community as well. And thank you for being a part of the community. So that's all for today. Again, I appreciate you being here, and I hope to see you all back in the Sectors Made Simple webinar in the near future. Take care.